Hey everyone, in this video I'm going to be talking about one of my favorite low-cost Canadian ETFs to buy. The company that I'm going to be talking about, or the ETF, is the BlackRock TSX Composite Index ETF. This is an ETF that just encompasses the entire TSX, so it's a great proxy for the Canadian market if you don't want to be thinking about what sectors of the Canadian market to be investing in. This ETF is a one-stop shop to get exposure to the Canadian market across the board. It has extremely low management fees. I'll show you guys later in the video, but it has about a 0.05% management fee, which is as low as they come in the Canadian market. Looking at this stock over the long term, or this ETF, I keep calling it a stock, it is up 20% over the last 5 years on capital appreciation, but more recently it's struggled a bit more with the challenges in the Canadian market, high interest rates, some macroeconomic pressure. So the stock's actually down 1-2% over the last year here. The company trades at a 14 times price to earnings ratio on Wealthsimple. I've seen in their prospectus and stuff that actually a bit lower, 12-13 times. So it's somewhere in that range, 12 to 15 times. And they do pay a quarterly dividend. So currently their yield on an annualized basis is about 3.2-3.3%. So you are getting some nice dividend from this as well, in addition to just ongoing exposure to the Canadian market. Lots of those dividends are coming from the banking sector, the energy sector, just all of the different sectors that are within the Canadian economy, and those stocks that pay dividends. Then we'll talk about some of those later as well, but that just all gets put into this fund and then paid out to you. Sometimes I like looking at Google Finance just because you can look longer term. So you can see here, this has been a fund since about 2001, and you can get a good sense of how it's gone, really closely mimicking the TSX Composite. So the stock was, or ETF was about $12 in 2001, has grown to over $30 here, paying dividends pretty much every quarter along the way. Going into this ETF a bit more, like I mentioned, very low fee base, and that's one of the reasons why I really like this ETF. I feel really comfortable holding this ETF over a long period of time, and knowing that I'm not getting my investment cannibalized to a great extent. Just under 0.1% a year is just fine with me for the exposure and the diversification. And I probably should have let off with this, but I actually have been starting to nibble on this company or position a little bit. Bought 15 shares. As you can see by percent of my Canadian portfolio here, it's really, really small still, but looking to build this up and up and up into a larger position, just to more broadly diversify my holdings. And I really do like still getting that nice quarterly dividend in from the Canadian economy at large there. So that's just some background on where I am personally with this stock. And the fees are one of the reasons, or lack of fees are one of the reasons that I made the decision to move into this ETF and try to build out a position in it. Looking at some of the holdings here, so you'll be familiar with lots of these companies at the top because it's market weighted for market cap. So you see lots of the biggest companies in Canada here. You got Royal Bank, TD, Canadian Pacific, Kansas City, which is a railway, CN Railway, Shopify, etc. here, Brookfield. So it's really all of the large Canadian companies are taking up the majority of this ETF. You got Suncor, Nutrien. I'll scroll through and you can kind of take a look, so I don't have to list off every company here. But I really like how deep this portfolio goes in terms of exposure to different sectors that you can see here on the right-hand side, as well as individual names across different industries. This goes on and on. We're still in the range that it's almost 1% each per stock. But by the end here, if I just go later on, you can kind of see some of these companies are now just 10 basis points, 20 basis points. So it's really holding the entire Canadian economy more or less in one ETF, which is great to see. Looking at their fact sheet here, company has done well over time. You can see that there. But even in the more recent time periods here, up about 8% year to date. And then over the last 3-year annualized, it's provided about 12% return. So really strong returns there. And even over the last 10 years, you're talking about an 8.3% return. And versus the benchmark of just the TSX, you're at 8.33 versus 8.37. So give or take, exactly mimics the TSX. Since inception, you're about 6-7 basis points off, which is just that very small management fee, which I can live with. So I think this company is really shown that they can provide stable returns, mimic their benchmark really well, and serve as a great proxy for the Canadian economy without charging you a lot of money to get that outcome there. Looking at their PE that they kind of quote here, they're talking more 13 times earnings here, trailing dividend yield of about 3.1%, distribution yield 3.2%, and then sector exposure. So this is just a microcosm of the entire Canadian economy here. You have financials and energy, pretty much 50% of the economy up there. But then you also get exposure to IT, so this is probably Shopify, some other tech companies, materials, utility companies like Hydro One, Fortis, I'm sure are in there, consumer staples, consumer discretionary, communication, so this would be like your Bells, your Rogers, your TELUS, real estate, a tiny bit of healthcare, and that's pretty much the big ones there as you go down the list. So you get pretty good sector diversification as is in the Canadian economy. Top positions that we talked really dominated by banking, energy, railroads. So, would be nice to have an economy that's a bit more diversified, but it is what it is, and that's just the downside, I guess, of having a Canadian-only ETF that you're investing in. But what I see as I look at more ETFs, I look for geographical exposure, stuff like that. I think that comes with a lot more complexities for these funds. Comes with different accounts they need to manage, have to set these funds up in different areas, and that all builds into larger management fees. So on lots of international ETFs, I see, at least that are traded on the TSX, I see management fees that are closer to 0.5, 0.6, whereas here you're talking about under 0.1. One thing I just want to kind of double click on is you see the portfolio yield here around 3%, just north of 3%. But even though this isn't necessarily a dividend ETF by any means, it's just a market ETF, they do have a lot of exposure to companies that raise their dividend every year. So I'd still expect to see dividend growth. Just wanted to share a couple examples. The first one was Alimentation Couche-Tard. I think they had about 2% of the fund in this company. In 2013, so 10 years ago, the company is paying 1.5 cents per share. As I scroll up, you can see here how well they've grown their dividend. 2016, they're up to 3, almost 4 cents a share, then 4.5 cents, then 5 cents, 2019, 6 cents. During COVID, they raised to 7 cents, and recently they've raised it all the way up to 14 cents. So they've gone on about 1,000% dividend increase over the last 10 years here. And this is just one example of many companies in this fund that do increase their dividend every year and will have distributable cash flow going up year to year. Another example is here, the trailing 12 months dividend payout, not yield, but dividend payout of TD Bank started at 40, 50, 60 cents a share, and this was back in 2010. We're all the way up to $3 or $2.75 a share. So up almost 1,000%, about 900% in the last 13, 14 years. And then the last one here, you see with Canadian Pacific Kansas City, they have their dividend growth over the last 10 years is about 7% annualized. Over the last 5 years is about 9% annualized. So over the short to medium term, even last 3 years, about 5% annualized. So over the last 3, 5, 10 years, these companies will continue to increase their dividend, or shown that they have and likely will into the future. So I feel like that 3.1% starting yield that they share here and that you see on the trailing yield will just continue to slowly build, get larger and larger. Your yield on cost will get higher and higher over time. So that's another reason why, while this isn't a dividend-focused ETF, I still think with the Canadian economy and the types of stocks in the Canadian economy that are taking up most of the index, this will still be a dividend growth ETF in its own right. So I just wanted to share this stock, ticker XIC, one that I've recently started buying, looking forward to building it into a bigger part of my portfolio. Right now it's at about 31.50, so definitely not at the 52-week low, but also a bit of a discount off the 52-week high. So I'm comfortable with where it's trading, and I'll just keep averaging into this, especially on days that I don't know what stock in the Canadian economy I want to be investing in, whether that's CN Rail, whether that's a bank, whether that's Fortis. I can just throw it in here if nothing's screaming at me, and I'll still get a dividend yield. I'll still get diversification across my portfolio. So Thank you guys for sticking with me till the end of this one. If you like this video, please give it a thumbs up. It really does help with the YouTube algorithm, and I will see you guys in the next one.